Okay, Ebele. So welcome to P Confidential. It's really great that you took some time from your busy schedule today to talk about your firm. And so we've got a lot to talk about. Your firm is obviously very active in the private debt markets of sub-Saharan Africa, and that's very much related to private equity. And it seems it's a market where there's a lot of things going on. So really, really great to have a chance to talk to you today. So perhaps I don't want to take all the words out of your mouth. So perhaps tell us a few words about your firm, what you're doing yourself, and then what your very exciting plans for this fund are. And we'll go into that in a bit more detail, during the course of our conversation.
Sure. Thanks, Gary, and thanks for giving us this opportunity. So Altica Partners is an Africa-focused investment firm. We are predominantly focused on credit products. So we feel that credit products give investors a good way and a safer way to access the Africa opportunity. We are sub-Saharan Africa focused on the credit side. We predominantly look at a number of sectors. So we have 6 sectors we focus on, including agriculture, something we call import substitution, which is kind of a combination of manufacturing and everything along the value chain. We look at healthcare, we look at education, we also look at media technology, and we look at financial services and, of course, energy. What we do on the credit side is focus on what we call the mid-market. The mid-market in Europe and the US means something very different to what it means in Africa. So mid-market is very different. It's a lot smaller. So what we look at companies that have net earnings between $500,000 all the way up to $50 million, who are looking to get capital, anything from 3 million up the way to 25 million. So what we found was as we were kind of building up the firm and building up the strategy, we found a lot of companies who needed capital, but they didn't want to sell an equity stake in their businesses. They obviously knew that African populations are going to grow tremendously over the next few decades. And what they wanted to do was to grow. And the only way they can get capital to grow was either by taking very expensive loans from non-banking institutions, or also selling a stake in their businesses to the equity firms. So what we found was a gap in the market, right? So a lot of the African banks could not give these companies the customized structures that they needed. And also, even if they could, they were not able to actually provide them with the level of pricing or the level of customization that they required. Because many African banks, aside from the top tier ones, find it difficult to raise capital internationally.
Mm-hmm. Oh, that's very interesting. A lot to unpack there. And just before we go on, so if I understand you correctly, your headquarters is in Dubai, right? That's where most of the team is located at the current time?
Yeah, correct. So we use Dubai as a hub for Africa, and we have local presence in 3 countries. We have in Kenya, in Nigeria, and in South Africa.
Okay, so you cover the three sub-Saharan kind of centers: West Africa, East Africa, and South Africa, which certainly makes sense.
Correct.
Absolutely.
Correct.
Okay, well let's go on to the question of your market. So before we talk about the sectors, I'd like to go into a bit more detail about that. So your markets are sub-Saharan Africa, so you're not doing North Africa. You're basically doing the 3 main centers of West Africa, East Africa, and South Africa. What was the reason for not looking at North Africa? What was the logic behind that?
So what we found was there's actually a lot of capital from the Middle East going into North Africa. If you look at the commitments that most of the Middle Eastern LPs have made in Africa, it's always been centered around Egypt, Morocco, Tunisia, and they know those markets very well. Most obviously because of historical trade ties and Islamic ties as well, and of course the language ties. What we found was actually when you move away from South Africa and North Africa, there was this sort of gaping hole in terms of capital flowing into Africa on the credit side.
Because obviously, so North Africa is kind of covered a lot by the Gulf institutions, and South Africa is a more developed market with more players, which gives you more of an opportunity in the other two areas. Is that kind of the logic on your side?
Yeah, that's right, actually. So South Africa behaves, in our view, quite slightly differently. There are a lot of good banks there. There are a lot of sophisticated banks. And there are also quite a lot of initiatives already set up for mid-market businesses, also a lot of Black empowerment initiatives as well. That's not to say we do look at South Africa, but I would say the bulk, when we look at our portfolio construction, the bulk of the deals we want to do would be East, West, and the rest of Southern Africa.
Okay, so that's interesting. And so it makes sense to be in Lagos and Nairobi, I think you said you were there.
Yes, Lagos, Nairobi, and Dakar.
And Dakar, okay, for the French side of it. Okay, and in terms of the sectors, I think anybody interested in Africa would recognize the sectors you mentioned there, traditional sectors, things like agribusiness, energy, education. That's linked to, let's say, one of the well-known themes in private equity of the growing middle class, emerging middle class, and which is a big theme in obviously in private equity. And so when you're talking about agriculture, what kind of agribusiness sector? Are you talking about primary agriculture, food processing? What kind of involvement do you have in that sector? Because it's potentially a very huge one in Africa, obviously.
Yeah. So agriculture is one of our core sectors, and within agriculture, we focus on what we call agribusiness, which is everything that helps to support the value chain. So everything from cold storage to processing, in agri-processing, trying to basically stop and reduce the amount of just pure raw material exports going out of Africa. So to enable these companies to actually pick up an extra piece of the pie, an extra piece of the value chain, trying to kind of allow them to produce as much as they can and do as much as they can onshore within the country, so they can actually, and they export, they can generate additional foreign currency revenue.
So the logic would be to not just to support the cocoa bean producers, but help them start to make chocolate, as it were.
Correct. We actually have a couple of companies in the pipeline now who look at the cocoa side. We actually have another company in Rwanda in the pipeline who produces coffee, and what they want to do now is be able to wash the coffee and process the coffee beans before they export to the US. So what we want to do is to allow these companies to do as much as they can locally, and basically generate more revenue, which will allow them to transform the environment.
Okay, and all these sectors that you cover, are they more or less in equal weights, or are you seeing at the moment one particular sector or two really going through a good period and some are a bit quieter? How are your various sectors performing? I think we're financial services, agribusiness, energy, education. I think there's a couple more that I can't quite remember that you mentioned.
So the truth is actually what we really want is not always what we see. So our focus, our largest sector is energy, and within energy, it's of course the renewable energy. So we've allocated that we can do up to 40% of our portfolio in energy. In reality, a lot of what you see is manufacturing. You see quite a bit of real estate. You see a lot of consumer business, which is great. But then there's other sectors like media and technology, which we really want to put more money into. And that sector right now is massively dominated by venture capital money. And what we're starting to see is a lot of these venture capital companies coming to us and saying, hey, look, we need, our portfolio companies need credit to grow. Could you give us a small ticket in terms of something like venture debt to allow them to accelerate their growth? So technology is a sector which we're not seeing enough deals in yet. I think it's just partly due to the stage and the cycle at which African technology firms are. And also because, some of these sectors were really neglected, right? So, for example, data centers, we're seeing a huge investment now in data centers. which was never the case. There's only been a few data centers in Africa.
Well, that's very interesting, and it's also my cue to move on to market players, because I think you said something very interesting, which is about venture debt and how some of the venture capital players in Africa are turning to you as a kind of ally or potentially as a co-investor with your product. So how are you seeing the venture debt market? I mean, clearly, even if we look at developed markets, venture debt is a little subset of venture, or it's not the same kind of an asset class as, say, mezzanine. So tell me a bit about venture debt. Are there any particular players in Africa? Who is doing venture debt? Is a lot of it done just by the venture funds themselves, where they'll put some money as equity and some as debt, or obviously you're a dedicated player. So how does the venture debt landscape look in Africa at the moment?
Yeah, it's actually very slim. There are very few players. In fact, there are no. I mean, what you have is a whole bunch of institutions who are DFI backed, who are happy to lend to financial institutions, small financial institutions. But in terms of traditional venture debt, there are very few players, because one of the challenges of venture debt is once you lend to a lot of these companies, you have to handhold them and train them and give them a lot of skills they need in order to utilize the capital properly. So what we've seen is a lot of venture capital firms trying to do the two at the same time, and then all coming to us and saying, hey, could we partner with you? We'll bring the equity, you bring in the debt, or we'll support this company up to a certain point where they meet your minimum requirements and transition them over to you. I mean, venture debt is a gap in the market, but it requires a lot of hand-holding in terms on the portfolio company side.
No, that's clear, because all these venture debt, we're talking about investing or placing funds in companies which are at a younger stage. But how does it work? Because surely you would expect you being a venture debt provider and somebody coming along being the venture capital company, would you expect them to be the ones doing the heavy lifting in terms of hand-holding the company, sitting on the board and all the rest of it, because they're the equity partner after all? Or do you find yourselves also, getting engaged in some fashion with the company? I mean, where would you sit on the scale of the level of involvement, hand-holding that you referred to?
Actually, we're quite hands-on. So we may not be a board member, although it's not uncommon for us to be invited to join the board. What we typically have is a board observer position, where we can oversee what's going on. The private equity firm or the venture capital firm would typically be sitting on the board, and we quite like that, because they think a little bit like us in terms of governance. We are reassured that someone's going to be keeping an eye on things. But also we find that a lot of the companies quite like us to be part of the decision making, because they see us as sort of an independent sort of voice in the company. So it's not uncommon for the CEO of a company to come to us and moan about something that the venture capital firm is trying to do with the business. And for us, what we're really interested is cash flow, right? We want to make sure that the company can continue to generate cash flow and to continue to service its debt, and obviously eventually grow and give us some kind of equity upside. So we work quite well with the VC guys, and the portfolio companies tend to use us as sort of a backstop, so to speak.
Oh, that's interesting. So you presumably have developed and are always developing relations with VC funds, and you would sort of work alongside them, and so the owners or founders see you as a kind of second opinion compared to the VC funds. I mean, do you generally the kind of engagement or the kind of arrangement you have with VC investors on investments, is it a kind of standard one where you say to the VC, well, you take the board seat, I'll be an observer, we'll do this and that? Or is it very much more customized depending on what the investment needs, how you find your modus operandi to coexist with the VC? How does that play itself out?
Yeah, it's very customized. So we've seen situations where we see a business that's already been invested in by a VC or even sometimes a DFI. And we look at the business and we identify, prior to actually agreeing a facility, we will identify different points and different things that we would like them to tweak or change. before we would invest in them. So, and a lot of these things, we actually try and put them into the term sheet to try and make them contractual. One of the things which we, for example, we look at everything from, say, the way they record sales to the way they manage their accounts. Nowadays, one of the things we like to encourage is cloud accounting systems. So we can actually physically log, rather than relying on quarterly statements, we can actually remotely log in and see what's happening in a business, right? So we try and get a little bit our hands dirty, almost in a way a private equity or VC firm would, but there comes a point where we step back and we let obviously the equity holders run the company. But we've set up these. One of the things we've set up is sort of these early alert systems and warning systems to allow us to identify things going wrong. It's also another role which we play, being having a leg in Dubai or in the Middle East, is also helping a lot of these companies attract new markets, right? So we've seen a lot of companies come to us and say, hey, look, we'd much rather deal with you because we know we can get access to, say, a particular new market, new client base. So there are a lot of additive things that we do. We can bring in consultants, we can bring in marketing specialists. We've brought in a number of social media specialists to help a lot of consumer firms help market their businesses and set up their businesses.
Yeah, because it does seem to be you having a firm which has also obviously got an advisory capacity and being quite a substantial team in Dubai, that you're kind of plugged into some international financial centers, and you have resources, particularly with your online resources, which we'll talk about in a minute in more detail. But compared to, say, a small VC, based in Africa, it seems to me that you have quite a lot of firepower that you could bring to bear in order to be more than capital, which is interesting because often the debt providers wouldn't do that. They would, they would simply lend the money and that's it. I'm thinking of a bank. So are you finding that this is something that equity providers always say? They say, well, I don't just bring money, I bring this and that. So are you finding that this is giving you a kind of good leg up, your obvious extra dimension, particularly in terms of online systems and being plugged in?
Yeah, it is. And I think it's also because of the ticket size range we play in. So we were lending to a multinational who had a lot of systems, had a central treasury, had a risk management team and so on. If we unfortunately don't lend to a lot of these kind of companies, we're not looking at these kind of companies. These companies are companies that will have these systems and processes in 5-10 years. But what we try to do is sow the seed and try and get them to think about these things very early on. So it works quite well, and it's necessary for us to actually make sure we get these companies to grow, we get them to give us back our capital with the returns that we've promised our LPs.
Yeah. No, obviously, if you're going in the middle market, there's so much more potential because the company may have a bit more hair on its chest, as you indicated, compared to a multinational. But that's an opportunity for you, to create value and then get an exit, particularly if you have some equity component. What's been your experience of engaging with, VC funds or smaller growth funds in Africa? What's been your experience from your vantage point of the variation in their skill set and their ability to make investments and manage the companies? Are they all pretty good, or is it quite a mixed picture out there? What's your experience of that?
It's quite a mixed picture. We've seen so we have typically two types. We have VC firms who are funded internationally and have brought in a lot of Western style structures and skill set and flown into Africa to set up. And there are a few select niche players who are local grown, on the ground, know the companies inside out, are really sort of very, very involved in the businesses. We don't speak to too many VCs because a lot of the their ticket sizes tend to be a lot smaller towards the lower end. But we've seen. I think it's a little bit early to say as well because the VC community is also is evolving, right? So, but I think from what we've seen, it's been great, especially in the tech sector. We haven't seen. There are certain sectors which we would like to see a lot more VC involvement, particularly the consumer sector, manufacturing as well. We'd like to see them step up. But from what we've seen in the tech sector, it's been great, right? But it's still early days.
And what about working with banks? Have you been in situations where, for example, a bank company says, well, we've got this company and they're kind of maxed out on the senior debt, and so, or the founder comes and say, well, I'm maxed out on my senior debt, and I'd like to get some sort of a subordinated debt from you because the bank can't extend me anymore, and so the deal comes to without an equity partner, but more from a founder and the bank. Have you seen many deals like that, or that kind of a sourcing?
Yeah, so one of the ways we actually, one of the unique ways we source a lot of our deals is actually through banks. So it's we've seen a lot of banks who want to actually deploy capital to the mid-market, or have raised capital specifically from global institutions or impact firms to or even DFIs to deploy capital into the mid-market. But it's very difficult for them to focus on this space because a lot of these companies are quite small and they need a lot of hand-holding. So we've seen a few banks come to us and say, hey, look, we've got this company that needs $7 million and they seem okay, but we don't have the manpower to portfolio monitor them for the next 3 or 5 years. Why don't we work together? You bring $3 million, we bring $4 million, and we partner together, and we co-manage and we co-monitor the company. So it's not. We actually like that because one of the best ways to understand how a company behaves is to speak to their local banker. In Europe or in the US, we could go and buy a credit report from from an Experian or someone like that. But actually, in reality, in Africa, you can't buy those credit reports. If you want to know whether a company pays their employees on time, if you want to know whether they, on the trade finance or LC, whether they perform properly, the only way to kind of know that is to look at the bank statements and speak to their corporate banker.
So there's the importance of the relationship with the bank, but what you're also saying is that the banks themselves, their corporate lending capability or risk management is limited. In other words, they don't quite have the skill set that you may bring to bear in terms of hand-holding the company, and they're more passive, and so they welcome your extra capabilities. Is it something like that?
Absolutely. That's something that they really like. And of course, we're bringing in additional capital, and it allows them to reach more clients and keep their customers, because the bank is earning revenue from multiple sources, on their trade finance, on their currency exchange, and elsewhere. So what the bank doesn't want to do is to lose that company to another bank, or even have a PE firm come in and take over the business, and they may have less business to do in the long term.
Yeah. Do some of the banks themselves maybe offer a kind of venture debt or mezzanine type product themselves? Because I'm just thinking about the players. Obviously, you've got the pure venture debt players who are, a handful of them. There's yourself and a couple of others. You've got the mezz players who will do more classic mezz, but you've also got the banks and the VCs. So, if I'm thinking of where the supply of venture debt or mid-cap mezz comes from, would it come from? Who would it come from? It seems it could come from quite different quarters. The equity fund themselves, the banks, the specialist players, a mezz fund. What's the kind of configuration of where the supply comes from?
So the supply is very thin, and that's why we have a term called the missing middle. I think we've seen a few banks a few banks have set up what you call commercial banking teams who are supposed to target this mid-market space. We've seen a number of banks in Mauritius. We've seen a few Nigerian banks try this out, but it just hasn't really. They haven't been able to focus and drill into this market properly. So what you have is a whole bunch of companies who are too big to qualify for the sort of microfinance style, capital that comes in via multiple routes and the multilaterals and the DFIs. And they're too small for the big banks, right? They're too small for the local banks, and they're too small for certainly too small for the international banks. So they either, a lot of them, what happens is they just end up trying to grow with their own equity, or they get frustrated and sell to a PE firm, or they just die. So if you look at the consumer space in Africa, there are a lot of local brands that have died over the last 15, 20 years just because they can't get that capital to grow. So it's a real problem. You can only see that if you look at Preqin and you run the numbers and you look at the number of registered private equity and VC firms in Africa, they're over 200. If you look at the number of active MES mid-market or funds in Africa who are deploying capital, I think you're looking at probably 5 right now. So it's a real problem, and I think, and obviously with everything with COVID and so on, COVID has actually created a crisis in a way, because you have a lot more companies looking for capital, and you have the big companies looking to restructure. So the smaller companies who never had capital in the first place are now really struggling, and they're now open to actually open to more expensive terms, which probably won't be good for them in the long run.
Okay, that's interesting. Let's maybe talk a little bit about the kind of deals that we're doing. So we've talked quite a bit about the players and sourcing and the deals. What kind of deal structures do you use? Do you see in the market? Is it kind of a kind of plain vanilla mezz loan, bullet repayment with some equity warrants? How much flexibility, how much customization goes on? What are your kind of broad deal structures that you use? And then maybe we'll talk a bit more in detail.
Yeah, so typically when a company in this space comes to us, they think they know what they want. Actually, often what they want is not necessarily what they need. So what we try and do is look at their business, look at the growth, the growth trajectory, and look at the cash flow, and we try and figure out what kind of structure makes sense for them. So if you're a company that you have a lot of assets, you potentially have a lot of collateral, then more of a traditional lending route, more of a senior secured type of facility would make more sense, and we would try and structure something that works well with you. If you're someone that is sort of probably is looking to grow aggressively, and you need that sort of first year or first 6 months of capital injection where you don't have to pay anything back, we can customize that. If you're a company that already has debt somewhere else, it's not uncommon for us to try and to look at, figure out who it is, whether we can work with them, and try and come in as MES. But in those cases, of course, we'll be looking for some kind of equity kicker. I think in terms of sectors, the most exciting space for customizing structures is in the agribusiness space, which is, and the reason for that is we've seen a lot of, there's a gap in the market where we see a lot of companies who need capital, but because of the variation in their revenue, because of, you just don't know how much they're actually going to produce, how much they're going to sell, and also the commodity price is also moving around all the time. We've actually come up with a number of interesting ways to structure deals in that sector. So we look at situations where we can vary the interest rate of a company based on where, say, the cocoa price is or where the coffee price is, because those prices are actually quite transparent and internationally traded. And we can also help these companies to get a fair price for their product, because they can actually hedge rather than signing an offtake agreement with a company at below market rates. We can actually help them mitigate their downside risk and hedge the commodity at the same time. Now, in terms of PIK and warrants, the amount of sort of PIK that we would be looking for would vary on the type of industry. Of course, if we're lending to a financial services company, getting an equity stake in their business is often quite a tough conversation to have with the bank or financial institution. Whereas if you're a tech company or you're building a data center or something like that, we would be happy to, we would want to grow with you, right? We would like to structure something where, as the company progresses, the value of our investment would grow alongside us.
That's very interesting. I'm very interested in this concept that you have this ability to customize so much. So I'd like to go back, if I may, to the agribusiness sector, because I think you've made some fascinating comments I'd like to explore a bit more. So what you're saying, obviously the main issue with agribusiness is commodity prices and I suppose seasonality, when the crop is coming and when they need and you're able to design products that can work around those two factors. And so what would be the main characteristic of a product? They would be more like a kind of subordinated loan. You would map out the coupon payments according to commodity prices, which I find very unusual and interesting. What are some of the typical products that you might deploy, that you might really customize for them, just so we can understand how they work?
So one of the things we really like, and I think a lot of the companies in the agri space like, is royalty-based structures where we would effectively give them capital. Where they know their base case, so they know, they've probably been doing this for about 5-10 years, so they know what the minimum amount they're going to produce. And because they know the minimum amount they're going to produce, we can basically back calculate what the minimum revenue they will generate. So we could do, say, a loan at, say, LIBOR plus 6%, something like that. And we could then have a royalty structure whereby we take a percentage of profits from their produce. So if you had a fantastic bumper year, you would be given, you would be paying us a very affordable interest and repayment, and at the same time we would be able to tap into the share of the profits. But only if you had a bad year, basically due to weather or due to or a variety of sector factors, or the commodity price fell, the percentage of revenue you would get would be a lot less, and we would also get less. So a lot of companies in the agriculture business like this, rather than actually taking a fixed 5-year loan, which is a fixed 5-year amortizing loan, which come rain, come shine, in good times and bad times, you're paying the same thing. So that's probably the most popular structure I see that people quite like in that sector. And then there are other structures which are typically borrowed from the oil and gas sector, where in the oil and gas sector, before you do any kind of reserve-based lending, or before you do any kind of tolling agreements and so on, you would try and hedge the oil price. And so what we try to do is try and replicate a lot of those structures, which is sometimes really big syndicated facilities, into smaller companies in the agriculture sector as well. So if you're a company, if you're a company that's producing any exchange traded commodity, we can literally replicate those things. So if the interest rate goes up, if the coffee price goes up, we could adjust your interest rate, and if the coffee price goes down, we can adjust your interest rate downwards as well.
So you can help create hedges for these companies over and above the loan by using your sort of knowledge of that.
Correct. So it helps out. It's good for the company because there's certainty on cash flow on the downside. It's good for us because it protects our loan book as well. And it allows us to get comfort on being able to give our investors back their return on time as well.
That sounds very interesting. It sounds like quite an exciting niche, within a certain sector that you could really occupy, and for which there potentially could be a lot of demand, I could imagine.
I think so. One thing people talk about, the growing middle class. People talk about a lot of things, a lot of good things in Africa. People having mobile phones and so on. At the end of the day, Africa is really still a commodity story, right? If you look at each country, most countries have one or two commodities or more that dominate the economy, and that's their source of foreign exchange. And unfortunately, Africa is a price taker in terms of commodity prices. So if you look at most commodities in Africa, whether it be in whether it be on the oil price, whether it be on the cocoa price, whether it be on palm oil prices. Palm oil prices are determined in Malaysia, but those prices are determining the amount of revenue every African or most African countries generate. So if you want to, the way we look at risk is very different. So if you want to understand what's driving an economy, we basically look at two things. We look at the commodity price and we look at trade. We look at trade going into the country and going out of the country. And that gives us a good high-level view as to what the prospects for a particular economy is.
That's great, and that's the perfect cue for our next topic, which is risk and risk management. So I was wondering if you could tell me two things. Firstly, what you see as the main risks of investing in venture debt and mezz debt in Africa, and tell me a little bit about your kind of software system for risk assessment, which is something that seems quite innovative and certainly beyond the kind of scope of many of the smaller funds that are out there. So it could be quite interesting to hear about that. So what are the main risks in Africa? Obviously currency is one of them, but what would you say is the main ones, and how would you help to manage them?
Yeah, so there's lots of risks, as you mentioned. Currency, of course, is the first one. So within currency, it's not just volatility of the currency, it's the availability of currency, right? So if you are sitting outside Africa and you're trying to deploy capital in US dollars, you need to think about the currency fluctuation. You can't actually. We have a policy internally, which is that we don't speculate on a currency, and that basically means that you need to giving a dollar loan or a euro loan to an African company without thinking about how you're going to get your money back is speculation. So as much as possible, we try to find ways to mitigate that risk. And we use a variety of tools. So we use what we call soft risk management, which is nothing to do with financial markets. It's trying to make sure that we focus on companies that can naturally generate foreign currency, or we look at companies that we look for other sources of how they could generate foreign currency. So we could potentially find another company that exports and use their export proceeds and feed it through that company to make sure that we get some money back. We also look at hard risk management, and the problem in Africa is a lot of African markets are not as sophisticated as a lot of the European and US markets. So when you're trying to do things like FX forwards, you might be restricted to doing up to a year, 2 years, sometimes even 3 or 6 months. And in some markets, in most markets, you can't do any sort of options on the currency. So what we try to do is look for proxy ways we can mitigate that risk. And we talked about, so if you're looking at if you're lending money to companies in Angola or Nigeria, you really need to look at the oil price. Even if you're doing a deal to say a pharmaceutical, a chain of pharmacies in Nigeria, you need to think about the oil price, because at some point, if the oil price goes down and stays down for 6 months, it's going to be difficult for you to be able to generate dollars. It's going to be difficult for you even to repatriate your dollars to the fund. So that's critical. Then the other part is availability. So you might have generated a lot of revenue from your investment, and you might be sitting in local currency, but trying to get that convertibility and trying to get it out at the right time might be a challenge as well. So we think about all these things. We don't think about them during the life of the we don't just think about it during the life of the facility, but we think about it at the beginning of every structure. And we try and set the hedges at the beginning of those structures so we can get certainty throughout the life and at the end of the investment.
Now, that's very interesting. And tell me a bit about your kind of risk management system because it's not just a question of a couple of people, jotting down some ideas. You have a fairly sophisticated software system, as I understand it, that helps to manage risks. So could you tell us a little bit about your risk management platform and what it does, how powerful it is and what its uses are?
Yeah. So effectively what we do is we have a system, in-house system, which we customize. We use the provider, we've customized it to suit our requirements. And what it allows us to do is to look at our loan book on a daily basis or weekly basis, and we can see, in that loan book, we can see, of course, the amount of capital that's we've deployed, what the balance is. We can see, of course, we can see what interest payments they are when they're due. But on the other hand, we can also see what the currency, what the exposures we have. So we can see the exposure across different currencies. We can see the exposure across different countries, and we can actually, one of the things we've actually recently done is to figure out a way that we can link certain deals to certain movements in the macro space. So as we talked about the oil price again, if the oil price goes down 20%, we would be able to identify that the deals we have in certain countries are at risk.
So it's a kind of a stress testing mechanism. You seem to be describing.
Yeah, it's a stress testing mechanism, and then also what it also allows us to do is if we put in, say, we can do a hedge across the whole portfolio, which is, I mean, a lot of these things I'm talking about, like banks tend to typically do them. So if you are concerned of, say, the currency of a particular country falling over the next 12 months, you could do an FX forward and hedge the total currency exposure across multiple deals. Right?
That's interesting, because I imagine that it's something that banks will do, but it's not something that a VC fund would do. But you seem to have brought in the ability of a bank to do this into a fund, into a venture debt player, which seems like you've got yourself a competitive advantage there of some kind.
Yeah, so that's something that we just think it's not. We see these are systems and processes that we've seen at the firms we worked in. Our team have done these deals at Standard Chartered, at Goldman Sachs, at Credit Suisse, and it makes a lot of sense if you're running risk across multiple countries and across multiple tenors. You need to be able to look at your portfolio and understand what a particular move is going to do to the probability of you getting your money back. We did a lot of work on private equity returns in Africa, and we found out that actually a lot of private equity deals were not bad. They were doing good deals. They've done a lot of good deals. But what happens is people tend to lose their share on the currency side. Or something else, or a particular input, say, prices of diesel suddenly spike. And if you're running if you have an equity stake in a logistics business, then, you're in trouble. So we try and look at all these different things. And we're not doing complex hedges. We're just doing very simple vanilla hedges. But also, sometimes we decide not to do anything. But not doing anything as well is also a clear decision which we make, and we document that we make that decision, because sometimes it's better to just ride the wave.
All right, well, that's fascinating, really interesting stuff that we're talking about here. And let's talk a little bit about this very exciting new project you've got going, which is you're planning to raise a fund. I think it's something around $150 million. So tell us what gave you the idea to raise this fund, and who are you planning the investors of the fund to be, and what's the fund going to be? What kind of deals is the fund going to be doing? Tell us all about the fund you're raising.
Yeah, so our new fund is again targeted at this, what we still call the missing middle, and it's targeted at this mid-market space. We're looking at companies who have very, very strong business, very strong business plans, who've historically have good performance, and no startups. We will not be investing in any startups. We're looking for companies that have at least 2 to 3 years of performance, who generate revenue between $500,000 to $15 million. We're looking at companies who have weathered the COVID storm, or would have weathered the COVID storm, but need capital now to sort of get back on track. We're also looking at companies that can generate a certain amount of impact, right? So it's not just about giving you money, but like how many jobs are you going to create? How many people's lives are you going to impact? And we want to make sure that we measure these things carefully. There are also a lot of things which we would not be doing in this fund. So we would not be investing in certain sectors, certain companies that do purely extractive businesses. So if you're just drilling oil and putting on a vessel and shipping out, somewhere, that's not the kind of thing we want to do. However, if you are drilling oil, but you're producing gas on the side, and that gas is going to an industrial park, that's something which we may consider. In terms of
basically, you're raising, it's going to be a commercial fund, but you're going to have ESG and impact criteria within which it's going to operate, but you're going to be targeting commercial returns. Would that be correct?
Yes, so we're targeting commercial returns. We strongly believe you can generate commercial returns and also and create that kind of impact as well. They work hand in hand in a way. And we've seen that a lot of investors, a lot of the LPs are starting to understand that impact investing, and the DFI.
Well, I think you're right. I think just my experience of Africa is if you're working in Africa in the mid-cap space, just by being a decent private equity or venture debt player and more or less doing some decent governance things with the company, you have a much higher impact than you would if you'd invested in a developed market, just by the nature of things. Yeah. And so if you have a few specific more targets, you'll have even more of an impact. But it sort of comes naturally, which is a very satisfying thing if you're working in that space. So.
Yeah, that's right. That's absolutely right. So our new fund will take into account in those considerations. It is going to be looking at helping to give flexible structures that we've talked about to these companies to allow them to grow. We use a phrase internally, which is sometimes quite funny. We would say we're trying to get these companies ready for their wedding, which is we will tool you up, dress you up, get you all sort of fixed up, get you on the right path. Because eventually what we hope is one of the larger African private equity firms will be interested in taking equity stake in you.
Oh, one thing, will you also be trying to get equity warrants? I think that's something we didn't touch on earlier in the excitement of our discussion, but will you also be sort of looking to get some equity sweeteners or kickers as part of your deals in this fund that you're going to be raising as well? And what will be your target return?
Yeah, so when we for those kind of deals, we would be looking to try to price between 18 to 20% in terms of IRR. In reality, a lot of when you look at across the whole portfolio, we'll be targeting between 14 to 18% in terms of IRR. Not every deal we do will have an equity kicker or warrants. We would expect probably about 30 to 40% of our portfolio to have those in there. And the reason we're doing this is because we are providing capital and we want to participate in the growth of these businesses. And a lot of these businesses are businesses which should have been getting funded by local institutions or international institutions, but they've so far been neglected.
And how many companies do you think you're going to be investing in total with this fund? Because obviously one rule of thumb on the equity side is you don't want to invest in have a portfolio of more than 10 or 7 or 12 companies in order to properly manage them. I imagine with debt you might have a bit more leeway. What's your sort of target number of investments? Yeah, so we're targeting to invest at least up to 15 companies. And debt is slightly different to equity in the sense that we could potentially do a 1-year loan, we could do a bridge loan, and get our capital back and reinvest as well. So you could reinvest rather than just give it back to the LPs. Yeah, we could reinvest, and that's a conversation we're having with some LPs as well on this new fund. And also because we're not actually physically running these businesses, we are debt holders. We have board observer seats. We're senior. We know we get paid out first. It gives us a little bit more scope to take on a lot more portfolio companies.
but of course, we don't want to spread too thin. So we make sure that we set our team up. Of course, we'll have the local portfolio team on the ground. We have the central team. And of course, we will be bringing in a lot of technical assistance experts to help these companies along the way. So we feel like 15 portfolio companies is probably a good level, good way to...
Which would be an average investment size of kind of $10 million or plus or minus something.
Correct. Yeah.
And who are your LPs? What are your, obviously you're fundraising now, I don't want anything confidential, but what kind of LPs are you targeting? What do you think your composition of LPs is? There's always the DFIs, if you're doing anything in Africa, that always have to play a major role. But maybe in Dubai, you may be looking at some more Gulf capital. How's it looking on the LP configuration?
Yeah, so the DFIs, of course, play a big role in Africa, and we'll continue to do that. So we will be expecting to have a number of DFIs in our fund. But one of the things we really want to do with this fund is to catalyze new money, to bring in new LPs who've never actually done Africa before. So we're looking to where we'll be bringing in a number of Middle Eastern LPs for the first time, who've always wanted to do Africa, but have sort of been a little bit scared. And they've always gone back to the original MENA circle of countries, so North African countries. So that's one of the things which we're trying to do, bring in a number of Middle Eastern LPs. We're also looking at bringing in a couple of Asian LPs as well into Africa. If you look at the investments from Asia into Africa, particularly China, it's been really on the big infrastructure deals and big sort of government-to-government transactions you see from China, from Japan, and elsewhere. What we want to do is to give allow Asian investors to tap into the Africa opportunity via the fund route as well.
Yeah, and I think obviously if the fund is more of a debt type fund, you might find it that much easier of a sell than an equity fund, because debt's easier to collect and there isn't quite the same risk profile. So that might help the fundraising. Has that been your experience compared to equity funds?
Yeah, absolutely. I think if we were trying to raise an equity fund for this particular space we're looking at, it would be very, very difficult. I think our team, just having that experience from working in, by the way, the debt space in Africa has been dominated by banks. So if you're going out there looking for a 10-year track record or even 5-year track record, you'd hardly find anything, because all the skill set of deploying money, deploying debt to African companies has all been sitting in banks. And I think that Asian investors and Middle Eastern investors sees a lot of similarities between some of their markets to the sub-Saharan African market.
Yeah.
And it makes sense.
Yeah, and I think that's very interesting, which brings us probably to our last topic. I see that we're hitting an hour, and I don't want to keep you too long. It is a question of the team, because clearly fundraising is about having a credible team with a track record and the correct skills. And so tell me about what kind of a skill profile or experience profile a team such as yours needs to have, say compared to a corporate lending team in a bank or an equity team in a venture fund. What's the sort of ideal profile of the team members, and what makes them different from the other two types?
Yeah, so our team looks very different to what you'd see in a private equity fund, and there are very big reasons for that. The first thing is, of course, we needed people who have deployed time after time capital, so giving debt to companies in Africa and got their money back. And if you are in a private equity fund versus a bank, in a bank, if you do a bad deal in 1 year, you lose a lot of money from the bank, chances are you get fired, and you won't get a bonus. Whereas if you're sitting in a fund, you might do a bad deal in year one. We might do a deal in year one that doesn't actually turn out to generate a lot of IRR. But you might do a fantastic deal towards the end of the investing cycle and generate a fantastic exit. and get paid, and then your track record is great. So what we wanted to do when we were building the team was to identify people that have deployed capital time after time, year after year after year. We also wanted to find people that understand risk, understand political risk, understand the legal risk and the legal structures, and differences between different African countries on the legal structure side. And then we also wanted people who have very deep relationships with companies, with banks, with sovereign, with the governments, of course, because when you're dealing in debt, you're inflowing capital, you need to know the central banks, you need to know the regulators, you need to understand how the currency market works, you need to understand how the local debt market works, so you can accurately price and make sure you're not undercutting or overpricing things. So we managed to bring in all these different kind of skill sets into our team. Of course, we have one or two people who have private equity experience, but that's more to do with the valuation of the business, because some of our deals would include warrants, and we'd need to understand valuation as well. But at the core of our team is really about risk, and it's really about relationships and experience in deploying debt.
Okay, and where's your fund going to be incorporated?
So we have options. We have a Mauritius, for obvious reasons. It makes a lot of sense for Mauritius, and we also have a Cayman option. We are considering, a number of LPs have raised Luxembourg, so we're considering that. So we'll probably have a feeder fund structure into Mauritius or into Cayman.
Okay, well, if you need, I'm raising a fund in Luxembourg at the moment, so if you need any tips, give me a call.
Absolutely.
Okay, Ebele, it's been a fascinating interview. Thank you very much for your time. I think I think our viewers of YouTube are going to find this very, very interesting. You've done a really good job of presenting your firm, the market, and the fund you're raising. So all that remains for me is to wish you really good luck with your fundraising. As we know, a little luck always helps in fundraising. And thank you very much for your time. So thank you very much, Ebele.
Thank you. Thanks, Gavin. It's been a pleasure.